Hello, everyone. We are now in our discussion for Chapter 2 of Accounting 150, and we are discussing accounting principles. We're going to answer the question, who is the FASB? That is an acronym. We will learn a little bit more about what that means and how they're involved in accounting. But first of all, just some kind of background, some basis as we think about the rules that govern how we do accounting. We talked in Chapter 1 that there was a need for the rules, and now we're going to delve into what those rules might be, what those principles are that we have agreed to so that everyone is using a common language and definitions. So first of all, interesting question, and this happens all the time. Many people believe, and the term has been bandied around, that accountants are bean counters. The idea being that if they had to figure out something, they would be willing to count every bean in order to make sure they got it exactly right. And really, in today's world, in today's business complexity, that really is not the case. Accounting is exact when it can be, all right, and there are several places that it should be exact, but much of accounting, especially when you talk about the overall communication of an idea or the story that's being told by the numbers, it is not as exact as many might think. It's more like a painting. Not exact, but close enough that we can tell who it is, or in our case, having to do with financial statements or financial information, how the company is doing financially. You see on the slide an example of a painting on the left and a photograph on the right. There's a difference, but the painting is close enough to give you a representation, enough of a representation that we can know who it is, what the story is going on. So it's not necessary to be exact to convey and communicate the story. I think we all understand that in terms of other language when we are trying to describe to someone a picture in our mind or an experience we had. We would never be able to get exactly every detail in our description. But at some point, we would decide that we had got enough detail, enough information, and we were close enough to what really happened that we convey the story. And that's what we're trying to do with accounting. We cannot be exact. Now, on everything. I do not want to discourage being exact when that is possible. So when we are calculating the amount of a paycheck to pay our employees, that can be exact, and that we'd like to double check to make sure that we are doing exactly. But in real life, those kinds of exact things are handled almost entirely by computer and computer software, which is what computers do. They are very good at getting exactly right the math or the calculations. So when we can be exact, we will be. When it doesn't require too much time to reach that exactness. When we can't be exact, we may need to estimate. We may need to estimate the outcome of probable future events. That may be actually better at telling the story that we are trying to tell with the financial information than waiting till we know the exact correct answer and that we know exactly what the amount is. An example: if we sell to a customer, and we will talk a lot more about this process in chapter 5, but if we sell to a customer and the agreement is that we sell them the product and they are going to pay us in the future, and we sell those types of products to hundreds, maybe even thousands of customers, what we do not know for sure is that every one of them will be able and willing to pay us. Now, we can do things that we try to identify those that have a history of not paying, but even with that, there's no way that we can be exactly sure that every single one of them is going to pay us in full for what they bought. So it may be more accurate in terms of telling the story of our financial health to estimate some percentage of those thousands of customers that are not going to pay us, rather than waiting until all the money has been received, and then we can know exactly how much they're going to pay us. By estimating that, we're actually trying to anticipate our future financial health. By waiting, we were really making it harder to make those decisions, because one of the aspects of information to be useful in making a decision is it needs to be in time for us to make that decision. And therefore, if we have to wait and wait and wait for months to make sure we know exactly how much we're going to collect from our customers, that's maybe too long to communicate that information for investment decisions and so forth. All right, so we may have to live with estimates. We will seek for exactness when that is possible and when it doesn't compromise our decision-making ability. And we will be satisfied. We'll do our very best job to estimate, get as close as possible, understanding that there will be no way to know that it is exactly right until down the road, and we will live with those estimates. And the more complex the business and the more complex the situations in accounting, the more likely there is to be an estimate needed along the way. And we will see those as we go through some detail, especially as we reach the second financial accounting, principles of financial accounting class, Accounting 151, where we'll get into calculating some of those estimates and being able to identify where they would be used. All right. So that brings us a term that is used in accounting, not often elsewhere, and that's the concept of materiality. If something is material, that means it's big enough to matter. If it's immaterial, it's too small to matter. So when we are putting together our financial information, there are some differences from reality that will be too small to matter, and thus we will call them immaterial. And we will not be concerned that they exist, because our information is close enough that correct decisions can still be made. It does not distort the picture of the business's financial performance enough to change an investor's decision. So how much is that? Okay. Well, that entirely depends on the size of the company, the complexity of the company, and the reasons for the difference. So for instance, easy example to picture, when we looked at financial statements of Apple, they were rounded to the millions. So basically, when you round to millions, if it's less than $500,000, you round it down as if it doesn't exist. And if it's over 500,000, you round it up as if there was more. Those are differences from reality. Even if every number was completely accurate, which there's no way to know that that's the case, when we round like that, we are differing from reality. And basically, we're saying that difference, 500,000 essentially, isn't going to make a difference to the readers of the Apple's financial statements in the decisions they will make. They do not need that amount of exactness. They do not need to know more closely to be able to decide whether Apple's doing well, whether they're performing well and being profitable. You can imagine that you probably, I doubt that anyone in our class is, when looking at what our bank balance is at the bank, I certainly can't look at it and just round it to the nearest million. Or it would always be zero, because everything under 500,000 would be rounded to zero. Okay, and so it really wouldn't make any sense to keep track of it in those terms, because our balance, my balance, would always be zero. So that means that what is material to me, what means something to me, is a lot smaller than what it means to Apple and its readers. The other one is a harder to kind of wrap your head around, but I think as you think about it, would you be more upset about a friend coming and taking $20 off, let's say a roommate, or someone you gave a ride to, a good friend who found money in your car, or while you were running an errand, got in your wallet and took $20? I think most of us would find that somewhat of a violation of trust. We'll assume that they didn't tell you, that you realize this well after the fact, that would upset you, especially because you probably would have been more than willing to loan it to them if they actually needed it and they had just asked, but they didn't. Well, it's still just $20. Imagine the same $20, but this time, instead of it being taken by someone you thought you could trust, it fell out while you were doing something really fun, like you were on a roller coaster, or it was in your pocket and you didn't remember, and you went swimming and it came out, or whatever. Same $20. I want you to contrast just how upset you might be with the difference between your feelings in those two situations. Same thing when you're talking about financial information for a business. If the reason why it's off from reality is because someone in a position of trust, accountants, managers, employees took it, even if it was a small amount, or deliberately was misleading, even if it's a small amount, that would probably concern us more than if it was a honest mistake for the same amount. And so it would be more concerning that if they could get away with a small amount, that they could get away with more that we haven't realized yet, versus a mistake that they honestly, somehow there was a mistake, or that we just did rounding or whatever, and therefore the same amount would have been no big deal, but because it was deliberate, because it was to facilitate fraud, if you will, or theft, that would be more material. It would concern us more. It might be big enough to matter, even though the amount was relatively small. Okay, so that's the kind of thinking we do when we're looking at financial statements. We realize that when with financial information, there's so many things that are behind that, where the numbers come from, that there's no way to know that every single amount has been recorded properly. But we have in place situations where, in general, almost all the time, we get it correct. And that means that if there are times when it is off, it will not result in a big enough difference from reality that it would change decisions. And so we consider that to be immaterial, whether in the form of rounding, whether in the form of mistakes, whether in the form of estimates that are not exactly what ends up happening. All of those are going to bother us in a sense that we will try our best to do a great estimate, a close estimate, but it's not going to tell us that, and we're not going to use the term. I warned accounting students that we don't use the term very often, exact or accurate, when we're describing information that is financial information, especially that which is from a complex business. We're more likely to say that it is fairly stated, meaning close enough that any mistakes would not make any difference in our ultimate decision. We didn't make any material errors, any material misstatements, to use a very generic term. So, returning to a topic from our first chapter, if accounting is a language, it must have rules. We have rules so that we can all use the same agreed upon standards. So we have an entity called, from the SEC. They are a governmental entity under the Treasury Department, Securities and Exchange Commission. And way back in the 1930s, after the great stock market crash in 1929 and the early Depression era, the SEC was created by Congress to clean up, you might say, the accounting. Part of the blame for the crash of the market in 1929, certainly not the whole blame, but part of it was that there were a lot of companies claiming to have a certain amount of financial success that ended up not being real. And there was no rule about that you had to give any particular set of information. So some companies had this, said that. Some would give a lot of information, some would give very little, some would give misleading information. They would just set it up however they wanted. So Congress said, we got to get a handle on this. There's got to be some standards so that we can all understand what page we're on. So the SEC was created. The Securities and Exchange Commission was to really, well, it says there on the slide, to enforce accounting rules. Really, their job was to protect investors from being lied to. And we're talking about ordinary day-to-day investors. certain investors that have a level of expertise or wealth are actually not considered to be that big of a concern. They're assumed that they're kind of smart enough or can afford the risk enough that we're not all that concerned about that. So this really was to protect investors, and they have done that, or their goal in doing that is to set rules for how the financial information is communicated. So they turned around, and over time, first they did some of themselves, they delegated that to a couple of other entities, finally resting in the 1970s with the Financial Accounting Standards Board, which is what FASB stands for. So they delegated the rule setting process to the FASB while retaining the job of enforcing it. Like most of the time, the government needs to be the one that enforces it because they have access to the police power that is necessary to punish those who do not follow the rules. And the FASB has no such plan. So FASB is independent of government. It is an independent entity. And they have in turn created what we're going to talk about is general principles and a codification of the more detailed rules. General principles are like the overall goals of our financial information, while rules talk about individual situations. So real quick, we run to the FASB website. You can see FASB.org, and you're going to have an opportunity to do a little research here for one of our discussions. The codification is a fancy word for the rules, the more detailed rules. You can see that they always refer to the rules as standards. The codification organizes everything by topic. The accounting standards updates, ASUs, are by date. That's when they change the rules. That'll tell you which rules they changed in 2026 versus 2025 and so forth. All your effective dates for rules, because they have most of the time will set a rule and then tell you that you have time to implement it, so you have a chance to make it work, because some of these can be quite complex. What they are working on when they have their meetings, which you can, some of them are live streamed, you can watch videos of them, all that type of things. So this is the hub of what they are doing to set the rules as a private entity separate from the government. All right, back to our... So let's talk a little bit about the following general principles. Okay? So one of the first things the FASB's done, and they have updated this a couple of times since the 1970s, is set kind of the general principles. And you might say this is the groundwork. This is like the Constitution that guides the setting of the specific rules. Kind of like we have a Constitution in the United States that is supposed to guide the making of laws for more specific things, to say what is illegal and illegal. Very few actual rules in the Constitution, very few actual rules in the general principles. But they help us understand the reasoning behind the rules, hopefully. So first of all, financial reporting is primarily, so when we're thinking about who we're setting the rules for, we're protecting investors and creditors. That's our audience. That's who we want to have enough information. So our question is always, will this rule or this standard or this guideline give investors and creditors the right amount of information? Is it going to provide them with understandable information? Or is this making it so complicated? Have we asked for information that is so complicated to provide that the readers will not be able to understand it? And it has to be useful for making decisions. It means that, as it down later, it says it's got to be timely enough. We mentioned that earlier. You've got to have the information in time to make a decision. And it's got to help you either one of two things: predict the future cash flows, how much money is going to come in from this business, or how well did it operate in the past compared to, you might say, other companies, or to itself, or the year before, that sort of thing. So it's either got to provide you feedback on the past, so it can say, oh, we did better than we have done, or it's got to help us predict dividends, financial performance in the future. It's got to be relevant to the decision. So there may be information that, and it's hard sometimes to weigh relevant and reliable. Reliable means you can prove that it's correct. If you think about a witness who's reliable, it's someone who actually really was paying attention. Other witnesses may be not that reliable because they weren't paying attention, or they may have been distracted, or they may have been impaired in some way. Okay? So that's not as reliable. We want information to be reliable, something we can count on, that we can verify. But it's got to be the right type of information. Just good stuff to know does not make it relevant for judging the financial situation of a business. We try to make it as close to error-free as possible, obviously. We know that estimates are going to be not exact, but we don't want to make an out-and-out error. We want to verify it as best we can, or need it to be verifiable when we can. Meaning we can support it by looking at evidence, documents that show that that information is correct. And we don't want to be biased. We don't want to favor one outcome. We don't want to influence investors' decisions. We want to just provide them with the information they need, and then they can decide whether that's a good thing or a bad thing. We want to just say, this is what happened. They can decide, does that mean that the company is doing well or not? We do not, in our accounting, want to decide that something makes them look like they're doing well or not. And then today, the information is a lot less expensive than it used to be, but it's still a cost in people and computing power, if you will, to find all the information. So at some point, the detailed information that you might be able to provide may cost too much, meaning it will take too much time and effort to get that compared to what benefit, how much of it, what we gain from knowing that. And I think we all understand that. There's endless information. We can go digging all through the world, but at some point, the cost of spending your time on it is not worth it to know every little detail. And so we may decide that some information is not worth gathering. And that's an important distinction, and it comes with important decision making. Now, from there, we have some assumptions. to help clarify this picture we're presenting. These are some, when we say assumptions or principles, these are things we just kind of understand. Everybody's understanding as we go into and look at financial information. First of all, business entity assumption. That means that we all need to agree, we need to have an assumption as to what business entity we're looking at. Seems rather obvious, but it is not always obvious in practice, and so we have to have some understanding. For instance, if there are two businesses owned by the same person, does that make them the same business entity? And the answer would generally, most of the time, would be no. We want to look at one entity separate from the other. Well, then you've got questions like, well, what if they own, one person owns 50% of one of them and 80% of the other? Are they separate entities? And the answer is yes. They should probably be separated. We should assume that when we're reporting about a business, that we do not include the owner's financial situation in that business. It may have an influence, but it should not be included. So their house should not be reported as part of the business. That's where they live. That's their personal home. That would be part of their financial situation, but it is not part of the business's financial situation. Monetary unit assumption says we're going to assume that we can measure everything that we're going to put on financial statements in the currency that we operate in. And that if something can't be measured in dollars, maybe it's just a great idea, but it can't be measured in dollars, then we're probably not going to try to put it on the financial statements. We need to use and it needs to be a steady monetary unit. The same unit this year as next year. And so we will probably not worry about things like inflation, which actually changes the value of the monetary unit. Because a dollar today buys less stuff than a dollar 10 years ago. But if we're going to compare information from 10 years ago or 3 years ago or last year, we're not going to try to say, oh, those dollars are worth less or more. We're going to assume that they are the same. Time period. We'll often note that the financial information is for a particular time period. That's important. When you look at financial information, you need to immediately look to understand what time period is being measured. And that's important in terms of, if I'm looking at, is this time period being measured? Is this how much stuff they sold in a month, a week, a year, a quarter, 3 months, or 6 months? What time period are we talking about? We have to have that assumption. We have to be on the same page with that. Looking at how someone performed 5 years ago is a whole lot. You need to understand that that's the time period we're looking at compared to last month. Objectivity principle is the idea that we can verify things, that we want to be as objective as possible in accounting so that someone else looks at the same information, it would come to the same conclusion. Subjective means it's based on our opinion. With objective means that there's some objective standard, something that someone else could agree on if they also looked at it. We want to tell the whole story, full disclosure principle. Usually in the case of negative information about a company, usually we don't have to talk companies into fully disclosing positive things. We have to remind them that even if something is negative, we have to tell the whole story. We can't leave it off because it make us look bad, or that like the future is not as bright as we thought it was. Going concern It's kind of like air. It's hard, it's all around us. It's just an assumption that we all live with, and we don't think much about it until it is gone. So someone holds your head under the water in the swimming pool, and suddenly oxygen or air becomes very, very important. If a company is suddenly looking at bankruptcy, the going concern assumption is very, very important. But normally, we're just going to assume that the business that exists today is going to exist indefinitely into the future. We are not always going to be thinking, oh, what if this company's dead tomorrow? We were just going to go with the assumption that they will be a going concern, that they'll be still in existence a year from now, 2 years from now, 10 years from now. Matching principle. This will become more clear when we talk about the definitions on the next slide, but we generally want to show revenues and expenses in the same time period so that we can measure a company's ability to earn revenues matched up with the costs of earning those revenues with the expenses. We'll also talk about revenue recognition principle in the next slide. Conservatism and consistency. Consistency really is about following the rules consistently 1 year to the next and applying the accounting rules the same way in 2026 as we did in 2025. And we'll kind of give a definition of conservatism as well as we move on to perhaps the most important principles that give us a definition of what we're going to refer to right now as the accounting elements: assets, liabilities, revenues, and expenses. I want you to focus on, lists of assets, lists of liabilities, lists of revenues, lists of expenses can be helpful at first, but ultimately what we want to learn is the definition of each of these and how it applies to real life. So assets are those things that a business controls, okay, and is going to bring future benefit. So they own or control assets, and they're going to bring a future financial benefit. Liabilities are things that they owe, the obligations that they must take care of, satisfy, pay, where they have a debt or a obligation that it happened because of something, an event in the past. Revenues are what a company earns, what they normal business, what they do to bring in, and what they do to earn result from outside the company. And expenses are the costs of earning those revenues. All right? So things can be different depending on the situation. Okay? And we need to understand these definitions because it'll be key when we move to chapter 3 that we thoroughly understand what an asset is, because it will have a very particular place to go on our financial information. And if something is a liability, it will have a very specific place to go. And if we don't have a good grasp on what an asset is, we won't know where to put it and how to communicate that to our readers. So, and that's what the FASB defined, what an asset was, and the rules determine it. When they consider any change in rules, they are almost always going to look at how is this situation defined? What does this create? Does this business situation create an asset? Does it create a liability? Does it create a revenue? Does it create an expense? And as we'll learn more and more as we go along, many things will have two sides, okay, to the arrangement or the situation. Let's use leases as an example. So, if I needed equipment for my business, one of the ways that I may be able to obtain that is to sign a lease. That means I signed a document that gives me use of the asset. Most of the time, the ownership of that equipment remains with the companies that made it. So, Joe's equipment, okay, he transfers that equipment. I sign a lease that says I have an obligation to pay them every month for 5 years. And then I can use this equipment. What happens at the end of those 5 years could be various things. Maybe at the end of those 5 years, the ownership transfers to me. And so I can use it then after that for as long as it's still alive. It's still operating as equipment. So I don't own that asset. Technically, it's still owned by Joe's equipment, but I have full control over use of it. So for sometimes those types of arrangements, back years ago, the FASB had decided that did not fit the definition of an asset, that equipment, because you didn't have full ownership. That has changed. The FASB reconsidered. They can do that. Took them many years to reconsider, but at the end of that deliberation, and they considered all kinds of scenarios and situations and input, they determined that is an asset and that you have also a liability. You have an obligation to make that payment, and therefore you must record or communicate both the asset and that liability in the financial information. So there's one example where it's two things, and it's there was a disagreement about which definition it fits. I'll give you another example that will also illustrate the revenue recognition principle. Most of us are familiar with the concept of buying gift cards from the standpoint that we go buy them and use them as gifts or whatever, or redeem them ourselves. Doesn't really matter. We transfer money to a business. Let's say we're buying a gift card from Home Depot. When we transfer that, they give us a gift card. And the question from Home Depot's side is they have the cash now, the money that we gave them, which is an asset because it has future benefit, has value, has future benefit. They now own it. They control it. They can deposit it in their bank account, spend it on whatever they want. What do we have? We have a card. But that card allows us to get merchandise from Home Depot. Home Depot had made that exchange, but they have not provided us with any merchandise. The way Home Depot earns revenue, their business is selling you merchandise. That hasn't happened yet. So what they have our cash, but they have an obligation. They have a liability that means that they have to, when I walk in and present the gift card, they have an obligation to give me merchandise that I want up to the amount on the gift card, right? And they're not going to charge me for it. So when I buy the gift card and they receive my cash, they don't have revenue. They haven't transferred. They haven't earned it. Because I certainly was not transferring them cash just to have a card to put on my wall. That card just represents the obligation they have to me to provide merchandise. So when I use that card, that liability for Home Depot becomes revenue. So it starts out as a liability, but it becomes revenue because now they have transferred merchandise to me. I come in, I get my drill, they check me out, they scan the gift card, gets all recorded in the system as now it's been used, and they have now a revenue. They have done exactly what was planned, and earned my business. The expense is the cost of that drill. They bought that drill from somebody else. When they bought that drill from somebody else, it was an asset because it was going to bring future benefit. The whole plan was that they were going to sell it. Now they have sold it to me when I use my gift card. And so that cost that they put into that asset now becomes an expense because now there is no future benefit. The expense means that the benefit is in the past or is currently happening right now, not future anymore. When the drill was sitting on the shelf, it was a future benefit, asset. Once I take it, exchange my gift card, now it becomes an expense. And we want that cost of that drill to be in the same, recorded in the same time period, or match, the matching principle, with the revenue that they record for selling me the drill. Because Home Depot cannot succeed unless they are selling drills for more than what they're paying for drills. If they're paying $100 and selling it to me for $80, they will go bankrupt. But if they can buy them for $60 and sell them to me for $100, then that's why we want to match it up. We want the same drills sold in month of May to record it as revenue as the cost of those drills sold in May. That's the matching principle. One last example. Let's say that we start a business and we need some help. So we find an employee. And we will ignore taxes, payroll tax, all that stuff like that. But we find a employee, and our agreement with that employee is to pay them $100 per day that they work. Okay, we're not going to have to keep track of hours, whatever like that. Just really easy, so we keep the math very simple. So, day one, they show up for work. They work all day. At the end of the day, we say thank you very much, and we give them $100. A crisp new $100 bill, not counterfeit or anything. And what has happened in our business? Okay, well, we have less assets. Cash was a business asset. Cash was a future benefit. We can't spend it now. It's already spent. We gave it to our employee. That $100 represents the cost of their labor. In theory, the reason we hired them is that they were helping us to earn our revenues in our business. They were helping us, and therefore we needed their labor. And so it was a cost of earning whatever revenue we generated that day. Okay, so we had an expense of $100. We have less cash by $100. All right. Day 2. They come back. Okay. They work all day. End of the day, we say, all right. Instead of giving you $100 today, I'll give you $50 today, and I'll owe you $50 going forward, because that's all I got right now, $50 in cash. The employee agrees, okay, and what has happened? Well, we have an expense in our business. The cost of their labor is still $100 for day 2. So now it's been 2 days, total cost, total expenses, $200. But we're only down $50 in the cash, and the other $50 is a liability, right? We owe them. So the liability amount did not match the cost, the expense, because some of it was paid while the rest of it is owed for later. Fast forward to day 3. Coming back, $100 a day, work the whole day. At the end of the day, we say, we don't have any cash today, okay? So we just owe you the $100. So once again, you have an expense of $100. So each day, there has been an expense of $100, so a total of $300. But each day has the settlement or the situation has been different in terms of payment. Day 1, we paid it all. Day 2, we paid half. Day 3, we didn't pay any. So at the end of 3 days, we have $300 of expenses, cost of earning our revenues. We're down $150 in assets because we've given them a total of $150, and we owe or have a liability of $150. And you see how this would accumulate over time each day. And that's typically you don't get paid, right, at the end of the day as an employee each day you work. You actually have an agreement with your employer that they'll owe you for a couple of weeks and then pay you every 2 weeks or every week or twice a month or whatever the agreement is. That's creating an expense and a liability when that employer that we talked about pays that employee the next week, let's say, they get some cash in and catch up, then that will have they'll have used an asset, cash, to pay off their obligation or their liability. So I think we've talked about several situations that can be maybe a little tricky in terms of how these definitions are applied. But I do want to, again, reiterate that we want to pay attention to the definitions and the situation and how it fits those definitions rather than trying to memorize a list of all assets, liabilities, revenues, or expenses.